Hello, investors and traders. This video will explain Bollinger Bands indicator combined with other indicators so you can use this technical indicator in your investing or trading strategy. After a brief explanation of the Bollinger Bands, then we will go in depth in what indicators to combine with these indicators. Bollinger Bands are not a standalone trading system. As usual, one indicator does not make a strategy and should be coupled with other indicators and philosophies. So what if you combine Bollinger Bands with other indicators, which can give you better results for your trading? Study it, analyze it, adapt it. What is a Bollinger Band? A Bollinger Band is a technical analysis tool defined by a set of trend lines plotted two standard deviations positively and negatively away from a simple moving average SMA of a security's price, but which can be adjusted to users' preferences. Bollinger Bands were developed and copyrighted by the famous technical trader John Bollinger, designed to discover opportunities that give investors a high probability of properly identifying when assets is oversold or overbought. There are three lines that compose Bollinger Bands: a simple moving average, middle band, and an upper and lower band. The upper and lower bands are typically two standard deviations, plus minus, from a 20-day simple moving average, but they can be modified. What do Bands tell you? Bollinger Bands are a highly popular technique. Many traders believe the closer the prices move to the upper band, the more overbought the market, and the closer the prices move to the lower band, the more oversold the market. John Bollinger has a set of 22 rules to follow when using the bands as a trading system. Approximately 90% of price action occurs between the two bands. Any breakout above or below the bands is a major event. The breakout is not a trading signal. The mistakes most people make is believing that the price hitting or exceeding one of the bands is a signal to buy or sell. Breakouts provide no clue as to direction and extent of further price movement. Bollinger Bands are not a standalone trading system. They are simply one indicator designed to provide traders with information regarding price volatility. John Bollinger suggests using them with two or three or other non-correlated indicators that provide more direct market signals. He believes it is crucial to use indicators based on different types of data. Because they are computed from a single moving average, they weigh older price data of the same as the most recent meaning, and the new information may be diluted by outdated data. Also, the use of a 20-day SMA and a 2 standard deviation is a bit arbitrary and may not work for everyone in every situation. Traders should adjust their SMA and standard deviation assumptions according and monitor them. Bollinger Bands with RSI. It is very common to combine Bollinger Bands with another famous indicator, the Relative Strength Index, or RSI, to help confirm a trend's relative strength. In Bollinger Bands, we mentioned that prices would always be contained with the upper and lower bands. This is because 95% of the data in normal distribution will fall within 2 standard deviations from the mean. In the case of Bollinger Bands, we are using a 20-period moving average and a 20-period standard deviation. The traditional way of using Bollinger is to trade for reversals. If a price hits the upper or lower band, it is likely to reverse as prices have already reached the extreme end. The RSI is a momentum indicator that compares the number of days of security closes up versus closing down over a period of time. These values are plotted from 0 to 100, with overbought securities typically expected when the RSI returns a value over 70, and oversold securities expected when the value is under 30. Remember that the leading indicator provides an early signal before a trend reverses. When RSI hits the overbought region after a couple of days, the trend begins to reverse and a slope downwards. Conversely, when RSI hits the oversold region after a few days, the trend begins to reverse and slope upwards. Again, these things are not as simple in real life as everyone would be rich. But for now, let's just take this simplified version of how the RSI works. The strategy of using Bollinger Bands and the RSI is to watch for moments when prices hit the lower band and RSI hits the oversold region below 30. This would be a good entry price to buy. If you are looking to sell, you can wait for prices to hit the upper band and the RSI hits the overbought regions above 70. That's a simplified theory. The tricky part about this strategy is that prices can remain overbought or oversold for a long period of time, from weeks to months. Similarly, prices can hover around the upper band or lower band for a long period of time. It doesn't mean prices immediately reverse upon hitting the upper band or prices immediately reverse when the RSI hits the overbought region. That's why I say things are not as simple as theory, else everyone would be rich. But it does give you a good sense of where prices are at the moment. When the two are combined, the RSI acts to either support or dispel possible price trends. For example, if a stock price reaches the upper band of a Bollinger price channel at the same time the RSI reads 70, the trader could make the interpretation that the security is overbought. They could then sell the stock, buy a put, or sell covered calls. Suppose instead the price chart shows trading is reaching the lower Bollinger Band and the RSI is not under 30. In this case, the RSI is telling the investor the security may not be oversold, as the Bollinger Band seem to indicate. The trader would not immediately enter buy calls or purchase extra stocks, as the downward trend could continue. If the RSI is high enough, the trader might even consider a sell. Bollinger Bands with MACD. As the title suggests, traders can make the use of Bollinger Bands in conjunction with MACD to support trade setups. Bollinger Bands allow traders to view the cyclical nature of volatility, while the MACD is an effective trend-following momentum indicator. Using these two indicators together can assist traders when making high-probability trades, as they can gauge the direction and strength of an existing trend along with volatility. As a result, trader can use the MACD to assess if a trend is picking up momentum or slowing down and setting up for a possible breakout, while the Bollinger Band can be used as an entry trigger and subsequent confirmation of a trade. Bollinger breakout strategy using Bollinger Bands and MACD. Traders looking to trade Bollinger breakouts should consider the following steps. Identify a trending market using MACD. Look for divergence in the histogram of MACD signaling potential breakout. Look for entry on a break of 20 moving average or trend line. 4. Look for the confirmation of a breakout via breach of the Bollinger Band along with increased volatility, Bollinger Bands expanding and increasing momentum, longer histograms. A break of 20 period moving average sent a line with the Bollinger Band after witnessing the bullish divergence provides a signal to enter the long trade. The dotted line on the upper side of the channel represents trendline resistance and coincides with the 20 MA of Bollinger Band when prices break through it. A break of these two lines confirms that is a significant level, further reinforcing the bullish bias. The MACD indicator supports the bullish trend as the MACD line has crossed the signal line and continues to move above the signal line, showing strong upward momentum. The Bollinger Band then confirms the move to the upside as the price begins to walk the band on increased volatility, expansion of the band. Stops can be placed below the lower Bollinger Band or at the low of the descending channel. Targets can be placed at a previous high or a significant level of resistance while maintaining a positive risk to reward ratio. Since there is a possibility that the breakout trade turns into a trend reversal, traders should consider multiple targets, levels, and manual move stops or utilizing a trailing stop. Advantages and limitations of the Bollinger Band and the MACD. Advantages. Bollinger Bands can be applied to any asset across any time frame, and the same goes for MACD. Bollinger Bands naturally provide stop-loss levels that coincide with the lower band for long trades and the upper band for short trade. Traders can determine the trend and volatility of any market at a glance. Limitations. The combination of the Bollinger Band and the MACD is not suitable for novice traders. Those that are new to trading will require in-depth knowledge of both Bollinger Bands and the MACD. Bollinger Bands are known to work best in ranging markets, while the MACD is a trend-following momentum indicator. If these are applied incorrectly, traders can receive mixed signals. Bollinger Bands with sentiment indicators. A sentiment indicator is designed to represent a group feels about the market or economy. These market psychology-based indicators attempt to quantify sentiment in the form of figures or graphically to predict how current beliefs and positions may affect future market behaviors. Sentiment indicators look at how bullish or bearish market actors and what they are thinking and feeling, which may help forecast investors' future behavior. When sentiment readings are unusually high or low, they begin acting in a contrarian way. For example, when investors are extremely bearish, that is often a contrary signal to the sentiment indicator traders that mark prices could start heading higher soon. Some sentiment indicators are CBOE Volatility Index VIX. Investors often use this indicator as a fear index because it spikes when investors purchase a significant amount of put options to protect their portfolio. Investors who buy put options believe the price of underlying stock will fall. If the VIX spikes, it indicates fear within the market. New York Stock Exchange NYSE high-low indicator. Investors can keep track of this indicator to compare stocks making new 52-week highs relative to stocks making new 52-week lows. Spikes in either direction often show extreme bullish or bearish sentiment. Contrary investors might use this sentiment indicator to buy quality stocks during periods of severe pessimism. New York Stock Exchange 200-day moving average. This indicator shows how many stocks are trading above their long-term moving average and is expressed as a percentage. For example, if the indicator is rising and shows that over 60% of stocks are trading above their 200-day moving averages, it indicates broad bullish sentiment. A reading over 80% suggests stocks may be overbought. Odd lot trading statistics. This indicator measures the number of shares being bought and sold in odd lots, which is less than 100 shares for most stocks. The theory behind this sentiment indicator is that retail investors who typically have at least amount of money are likely to buy and sell odd lots. Buy when bullish sentiment has peaked and sell when bearish sentiment reaches a climax. Therefore, when odd lot trading increases during market extremes, savvy investors may take a position in the opposite direction. The Commitment of Traders Report. This is weekly report suggests aggregate positions of different groups of traders in the futures market. A rising speculative position indicates a rise that asset prices. When speculative interest hits an extreme, though, it indicates price could head the other way. So, for example, when the Bollinger Bands hits an extreme or hits the lower end of the Bollinger Bands, you would use one of these sentiment indicators or two or three of these sentiment indicators to see if this is truly the bottom. So the oversold of the Bollinger Bands combined with a VIX or a 200-day moving average or the Commitment of Traders report will give a pretty good conclusion when the market has hit bottom. Bollinger Bands with unbalanced volume. Unbalanced volume, OBV, is a technical trading momentum indicator that uses volume flow to predict changes in the stock market. Joseph Granville first developed the OBV metric in the 1963 book, Granville's New Key to Stock Market Profits. Granville believed that the volume was the key force behind the markets and designed the OBV to protect when major moves in the markets would occur based on volume changes. In this book, he described the predictions generated by the OBV as a spring being wounded tightly. He believed that when volume increases sharply without a significant change in the stock price, the price will eventually jump upward or fall downwards. Unbalanced volume, OBV, is a technical indicator of momentum using volume changes to make price predictions. OBV shows crowd sentiment that can predict a bullish or bearish outcome. Comparing relative action between the price bars and the OBV generates more actionable symbols than the green or red volume histograms commonly found at the bottom of the price charts. The theory behind OBV is based on this distinction between the smart money, namely institutional investors, and less sophisticated retail investors. As mutual funds and pension funds begin to buy into an issue that retail investors are selling, volume may increase even as price remains relatively level. Eventually, volume drives the price upward. At the point, larger investors begin to sell and smaller investors begin to buy. Despite being plotted on a price chart and measured numerically, the actual individual quantitative value of OBV is not relevant. The indicator itself is cumulative when the time interval remains fixed by a dedicated starting point, meaning the real number value of OBV arbitrarily depends on the start date. Instead, traders and analysts look to the nature of OBV movements over time. The slope of the OBV line carries all the weight of analysis. Analysts look to the volume numbers on the OBV to track large institutional investors. They treat divergences between volume prices as a synonym of the relationship between smart money and the desperate masses hoping to showcase opportunities for buying against incorrect prevailing trends. For example, institutional money may drive up the price of an asset, then sell after investors jump on the bandwagon. Bollinger Band with using the percent B indicator. Another indicator used with the Bollinger Band is percentage B, which plots the stock closing price as a percentage of the upper and lower bands. The upper band is identified as 1, the middle band 0.5, and the lower band 0. The percentage B shows how close the stock's current price is to the bands. For example, if the upper band sits at $30 and the current price is $22.50, percent B equals 0.75, putting the stocks 3/4 of the way toward the upper band limit. This is helpful for traders to identify when a price jumps a band, which can determine divergences and trend changes. Bollinger Bands using the BB trend indicator. BB trend is a relative new indicator developed by John Bollinger to work with Bollinger Bands. It is one of the only few indicators that can signal both strength and direction, making it a very valuable tool for traders. BB trend reads above 0, the signal is a bullish trend. If BB trend reading below 0, the signal is a bearish trend. The degree above or below 0 determines the strength or momentum behind the trend. The BB trend offers an alternative to the average directional index, or ADX, which gives very, very similar readings. The squeeze. The squeeze is the central concept of Bollinger Bands. When the bands come closer together, constricting the moving average, it is called a squeeze. A squeeze signals a period of low volatility and is considered by traders to be a potential sign of future increased volatility and possible trading opportunities. Conversely, the wider apart the bands, the more likely the chance of a decrease in volatility and the greater the possibility of exiting a trade. However, these conditions are not trading signals. The bands give no indication when the change may take place or in which direction the price could move. Key takeaways. Bollinger Bands consist of a center line and two price channels or broad bands above and below it. The center line is typically a simple moving average, while the price channels are standard deviations of the stock being studied. The bands expand and contract as price actions become volatile, expansion, or bound into a tight trading pattern. Contraction. Traders designate the upper and lower bands as price targets when drawing the bands. When the price continually touches the upper band, it can indicate an overbought signal, while continually touching the lower band, an oversold signal. Bollinger Band works in a variety of different markets. Bollinger Bands is very useful when you combine the Bollinger Band with many other indicators, such as the RSI or the OBV, or even sentiment indicators. It specifically works well with sentiment indicators when the bands are touching much lower and the sentiment of the industry is very bearish. The Bollinger Band should not be used as a standalone indicator, but coupled with other indicators to use a weight of evidence. One indicator oscillator does not make a successful system. Please watch the other videos on MACD, RSI, etc. to combine these indicators to make a rule-based strategy. You know the catchphrase. Study it, analyze it, adapt it. Peace.